Welcome back into another episode of the XRP pod. Today is going to be good because I've got none other than Black Swan Capital on the show. So you guys can't miss that one. We're going to be covering everything from the Fed to what's happening in the current market and some of the strategies that maybe you guys should be looking at playing this out. So be on the lookout for that. Of course, some of the other things I want to kind of get into is our sponsor. And one thing that you guys need to be doing, and I think this is a challenge to everyone, is how are you playing the markets when we start to see this volatility? One of the ways, of course, you can do that is jumping over to OKX. It's very easy to set up over there. And they have some interesting components right now where you can start to really benefit both on rewards, but also creating kind of a stack method. And the process is you set up your account. You're going to get some bonuses, which is an opt-in to RLUSD matches. This, of course, is a campaign that is available for you guys right there on the homepage. So you can deposit, up to $1,000 in there as a new user, and you're going to earn like $50 in RLUSD. Then you can get up to 500 in Bitcoin when you complete all three of these tasks. So stack those rewards. Also stack your crypto whenever you want. You're going to start to earn up to 3.5% APY on RLUSD, and it's paid out weekly. So that's kind of a cool feature. And some of the other things that they are doing right now really gets into these tier levels. One is the deposit and the trade. You get a little bit back in Bitcoin, $100 back in Bitcoin, 50 in RLUSD. And then you can go into tier 2 where you deposit and trade up to 10K and you get 500 back in Bitcoin and up to 500 in RLUSD. When you get into the big whale categories, 500 back in Bitcoin, and that's like up to 100,000 on a deposit and up to 5,000 in RLUSD. So some very interesting programs for you guys to jump into. There's kind of the stack all three to be able to get into that. All right, so let's go over quickly. I just want to go into the market to talk a little bit here before I bring on Versan and Vandell. As you can see, we're on the XRP chart. Big dip yesterday. I think some of this has been because of the macroeconomics, but also clarity pretty much got rug pulled. And that is a problem, I think, guys, as we start to see the future of what's going to be happening here, at least in the near term. So be on the lookout for the market to be much more volatile, especially around what could be happening with the big three, which is going to be Ethereum, XRP, Solana, Stellar, some of those that, of course, could see a big issue. So I want to bring on the guys from Black Swan Capitalist, and you've seen them on the show here before. I'll bring them both the guys, and there we go. All right, Versan, Vandell, how are you?
Good morning. Doing very well, thank you.
Nice to see you both.
Doing good. Good to see you too.
So a lot happening, as you guys got a chance to see. Some pretty crazy things in the market in general. When you compare, I want to kind of lead off with the Fed decision, because this is one that I know you guys have been talking about this for a little bit. But when you look at the current possibility of a Fed decision, at least in July, it looks as though we're going to get a hold. But Vandell, let's start with you. What do you think? Do you think we're going to be on a hold here, or do you think this is going to be a little longer?
Yeah, I think it's going to be on a hold, but that doesn't change the long-term destination based on where we are in the monetary cycle at the moment. Mm-hmm. So the only reason I think they're not going to hike rates, even though most of a large percentage of the market is leaning in the odds of, I'd say, 37% probability that they will hike rates, I don't think they will, is simply because the 10-year and the 2-year yield in aggregate dictate essentially whether the Fed hikes, pauses, or cut rates.
Okay.
And the 10-year and the 2-year yield it's basically what currently leads the Fed's decision. Okay. Most people think it's, inflation or this or that. Those are important metrics, even though they're somewhat flawed to some extent and manipulated, but that's not what dictates monetary policy, especially interest rates, the Fed funds rate.
Right.
It's the 10-year and the 2-year yield. So when that starts shooting up aggressively, that's typically when you'll see rate pauses or rate hikes in that instance. That's typically what they follow. And if it goes the opposite direction, which is lower, that's when the Fed starts reacting and following, and what they'll do is they'll cut interest rates. So they're following that. And that's basically what the CME watch tool is. Of course, they're making their own anticipation based on other information, but that's largely where a large percentage of that is coming from. But I don't think it's breaking out high enough for them to have any reason. And if you just think about where we are in the cycle, they're not incentivized to raise rates. Okay, so far what they've done is they've kept rates elevated since 2022 for so long. And the only logical explanation for that is to put pressure on the system, on the economy, for other nefarious agendas, and to ultimately have a reason to aggressively cut rates later. So essentially, they're just buying time at this point. But there's no reason for them to hike rates. If anything, the most logical path forward is to hold, to buy more time, or to simply begin the rate cutting cycle, which I think will happen towards the end of the year or early 2027.
Well, okay, so you've got a low percentage here on July's meeting, but it starts to rise pretty dramatically, as you guys can see right there, as we start to flow into September and October's meeting. And I guess that's my question is, do you think we actually do get a rate cut later this year? You know, Vandell, you want to take it?
Yes, I do. It's hard to say exactly when it will be, but I think the path we're heading on, the path of least resistance, is ultimately to begin the rate cutting cycle and resume that path. So that's the direction we're going in. And the reason is simply because we're facing a debt crisis. Okay.
Right.
That's basically the elephant in the room. We have so much debt in the entire system, roughly $353 trillion globally speaking. That's corporate, that's government debt. But the government alone has to refinance between $8 to $10 trillion alone in treasury debt in 2026. And that's just exponentially growing, of course, because the debt is only growing over time and alongside the interest rate. So when they need to refinance the debt, which is about to hit this maturity wall, it's very difficult and expensive to do with elevated interest rates with where they currently are today. So in order to refinance that debt successfully, which is their main mandate, along with preserving the integrity of the bond market, they are going to have to lower rates at some point soon. And we've already went through the rate hike cycle. Okay, that actually started in 2022.
Right.
Now we're leaving that rate hike cycle and we're transitioning into a fiscal dominated regime, pretty much, with the need to refinance government debt, the need to fund these government deficits, and central banks are a slave to the governments, pretty much. So the only path forward is buy time as long as they can, and eventually they're going to have to cut rates significantly lower than where they are today in order to refinance that huge debt burden. Because if they don't, what's happening is what has happened every time in the past throughout history. We're eventually going to get to a point in time, hit a threshold, a wall, where we'll have a financial crisis of some sort. And that's essentially going to be because there isn't enough liquidity in the system to refinance the debt.
Yeah.
And in order to get more liquidity into the system, you get a print. And in order to do proper QE, quantitative easing, not this stealth QE thing that the whole narrative is surrounding these days, that this is not QE, okay? QE, in order to effectively do that and inject a huge amount of liquidity into the system, what they need to do is bring rates much lower than where they are today in order to do that. That's how they're going to get more liquidity into the system. And because the debt burden is so large, you need an equivalent ratio of liquidity in order to refinance the bulk of that debt. Okay. And the debt,
that's an incredible amount of injection of capital just to be able to maintain that. So this continues to end with the whole idea of hyperinflation. What most likely will come out of this is just more dollar devaluation. We'll talk about that. Versan, do you think that we get a rate cut late this year, or do you think it comes next year?
Well, there's no way to time it, but I think we have to be realistic about the situation. The real economy is in free fall. Job losses are surging. Credit card delinquencies at all-time highs. Leverage is at extremes right now. People are maxed out. They're broken. And, defaulting at levels that show us that there is a systemic collapse, right? Economic activity is contracting. And I think it's just, more monetary policy is just talk, because I think we have to be mindful that if we look at the past, like the 2008 financial crisis, what did they do, right? They did put QE into motion, but they're just going to have to print more money. And I think central banks understand this dynamic perfectly. I think they're prepared. And that's probably why they're buying gold, because they see what they're going to have to do. And going back to the emergency crisis of 2008, the pandemic shock of 2020, whenever servicing the debt and the financial system became painful and growth stalled, and that's what we're seeing today, they had to respond the same way. They did slash rates to zero or near zero and unleashed massive money printing, right? So it's very possible. I mean, if you look at the yen carry trade, if you look at some of the other systemic issues going on, there is no other choice. It's the only tool left they really have in their toolbox when conventional monetary policy fails. So I do think they're going to have some sort of emergency response, and they're just going to have to inject all this money into the financial system. And the evidence is clear. Pressure is building again right now. So high rates may feel responsible in the short term, but this is only temporary.
Just short term. Yeah.
Short term, exactly. And when that breaking point does arrive, which it will, and history shows that it always does, central banks are going to pivot hard. They're going to have to cut rates aggressively, and they're going to have to restart money printing, because that's the only way to stop this economic contraction.
Hey guys, when you look at, okay, so the big news today was basically we get rug pulled out of the Senate again. And what that is in reference to is the Clarity Act, because this starts to compound on what's happening, not only with the Fed, but now just with the regulatory environment. Word is now that the Senate is not going to vote on this before the Senate recess, August 8th. That's a major hit to the industry. We're seeing a little bit of a dip here in terms of the percentage dropping, even though there is still kind of a very thin window that could happen in September. How much does this matter, guys? Does this really matter for the industry?
Vandell, would you like to go? I mean, I'm happy to.
Okay, so it all depends on perspective here. So in the long term, it does matter, because essentially what it's doing, it's removing these barriers.
Yeah.
And something we saw with the Telecommunications Act. You remove the walls, you have regulatory clarity, institutions, businesses, they know what they can do, what they can't do. And you have essentially this wall that's removed, and you can allow for investment in the infrastructure, more development, use cases, utility, and it accelerates the growth and adoption, the S-curve. So that's basically what it does. So in the long term, yes, it's very important. It matters, but to debate whether it's going to happen or not is kind of silly, because it is going to happen. Just like all innovation and technological advancements throughout history, they get regulated, which means controlled, and they get adopted, and the space grows into something even bigger over time. By that time, later on in the future, whether it's several years from now, a decade, the return on investment from an investment perspective and the opportunity begins to compress as the market matures. So in the long term, it's important for the growth in the space. However, in the short term, it's not important. It's basically, they could utilize it in any direction to, serve, whether it's insiders or institutions trading it, and use that volatility and that narrative to essentially exit into strength. They could generate hype, they could dump it, they could short the market down when that happens. I mean, it's just a narrative in the short term. So to follow that very closely and base your investment decisions on that is not the right path to take, is what I'm trying to say. Because short term, it doesn't matter, it's going to go through at some point, and to focus too much attention on it is simply can be somewhat a waste of energy, because you don't know what's going to happen in the short
Yeah,
term.
for sure. Well,
So,
I think the point that everybody's been looking at is that if this doesn't get done, does it give one, the Democrats the potential to kind of run amok with regulation and rulemaking down the road if in fact we start to see a split Senate and House and or, a challenge in 2028 for the presidency? Who knows what's going to go on there? So I think this is still, listen, a lot of things are going to be playing out in the short term. I wanted to run in something past you guys because this was data point that I had seen in reference. We were researching this around corporate profits because we were looking at the S&P, but in typical, what we've found is that most U.S. corporations are now coming in profits that are hitting a record. It's like 14% of GDP. This is continuing to rise. This would almost be counterproductive to your argument, Vandell, is that eventually consumer sentiment is going to set in and we're going to see this kind of impact on the market. But all these companies are still making just record profits. What do you make of this?
well, if everybody is using, credit cards and in debt, then yeah, profits are going to be up, So it depends on the sector, it depends on the economy, but ultimately, if you look at the real economy, okay, it's not in such good shape, and you can see that in the labor market,
Yeah.
in
Yeah.
the job market, which is a leading indicator actually. And you could see that in, as my brother said, delinquencies. You could see it in the real world. You actually get more insight talking to people on the street rather than reading the Financial Times if you want to get a sense of what's happening in the economy and the job market, of course, too. And right now, I mean, yeah, earnings can be up. There's overinvestment in certain sectors. For example, a surge in capital investment
Exactly.
in AI, for example, which is temporarily keeping this bubble afloat and creating a boom within the market. And then you have
Yeah.
the Mag 7 that is lifting up the rest of the market. And that's what a bubble is. And basically, what we're seeing in the stock market is a melt up phase.
Yeah.
This is the blow off top. It just hasn't blown off the top
Exactly.
yet, but
Yeah.
this is it. Yeah, because this is not normal. Okay, if
It-
you've been around long enough, and I know you have, Paul,
It's not normal. You're
this
right.
is
I still
abnormal.
think
Yeah.
it's like any minute now, any minute we're gonna start to see this. Versan, you put out a tweet right here because this I think is very relevant that investors keep asking which asset replaces the dollar. Okay. And you guys can see it. Better question is which asset inherits the settlement of half the dollar's dual role. And you look at that, and of course, there's a handful of course, we know tokens that could kind of go in this directions and companies. But do you think it's going to be a broader market, or do you think it is going to narrow in on major projects like XRP, Stellar, etc.? Where do you see this?
Well, there are a few things that go into that. I think central banks, accumulating gold, reclassifying it as tier one
Yep.
collateral. That's very important. Every time we come on the show, we do talk about this because it's an
Exactly.
important
Yep.
reference point we need to remind ourselves, right? And why are they doing this, right? They're methodically and deliberately preparing for a monetary reset that's going to require a stable, credible, universally accepted reference point of value. So I do think the broader commodity market is consolidating right now. We have seen gold and silver come down and some other things, but I think it's going to be a basket of currencies, a basket of commodities that are going to be tied. And even in this kind of monetary reset, trust alone is not enough. You need a global monetary reset to have the ability to move capital quickly, efficiently, and across borders. And I think that's where XRP comes in and plays a very critical
Mm.
role.
I'm looking at the gold chart here. You mentioned that coming down. Versan, okay, so do you think 4K is kind of the new bottom for this, or do you feel like this could retrace more?
It's possible it could retrace. I don't really know. I don't look at technicals as much as my brother does, but in these larger cycles, gold is really consolidating for the
Yeah.
next leg higher, and it's anticipating things that we talked about as far as monetary policy. So it's going to go higher at some point. We don't know. But right now, you could see lots of repatriation of physical gold. You know, they're getting ready for something. So central banks are responding exactly as you would expect. And not just central banks, very smart individuals, very wealthy individuals too, you know.
I'm
Um,
hearing more and more gold investors coming out talking about the purpose of anytime we see a dip, like what we have seen with gold and silver down to 4K on gold, is that this is absolutely the next point to start another DCA, campaign.
absolutely. You should always be every month. I think it's prudent for individuals and investors alike to be putting a little bit of their earnings into precious metals, something that's real, something that's tangible, something that can't be diluted, and something that is gradually being reintegrated back into the monetary system. For instance, even silver, which was once a form of money,
Right.
which I still think it is, it has its use cases. Forget the industrial side. But when you're talking about sovereignty, you know, it still is money. At the same time, Central Bank of Saudi Arabia, Central Bank of Mexico, Central Bank of Russia, recently in the last like year or so, created these strategic reserves to accumulate silver.
Right.
That's not reported in the US. And if I'm not mistaken, the Trump administration, Andy Scheckman shared this with us as well, where they have this reserve now for strategic rare earth minerals, but silver was in there as well.
Okay, so between the two of you, and this isn't financial advice for anybody that's listening, entertainment only, but you're building a portfolio today, and let's just say you could quantify this on a magnitude of whatever you want to scale it as, but let's just start with $10,000, okay? Today you're in a $10,000, you haven't been in the market. You've been looking for this bottom that everybody's been talking about. Maybe it's Bitcoin at 64, 65K. Maybe it's XRP at near $1. Out of a $10,000 portfolio, how would you split that up in terms of diversified components? Vandell, you pick one. Versan, you pick one.
Yeah. So the way I would look at it, of course, is you have to you consider your age, your risk tolerance, your
Sure.
time horizon. These are critical factors.
Let's go with a 40-year-old
Okay.
with average risk, because I think there's a lot of people right now, in the market, average risk. If I look at our own, listeners and viewer demographics, that 40-year-old is the sweet spot.
Yeah. And time horizon?
Time
Because
horizon,
that matters
20
too.
years.
Okay.
Going to 60 where they retire.
Yeah. So what I would do is, this is something I learned, that concentrated portfolios actually perform extremely well compared to portfolios that are spread out too thin. You actually get diluted returns, okay?
Interesting.
Rather than better performance. And essentially, you want to have something that you preserve your wealth that is timeless, okay? So I would choose precious metals for a small percentage of that portfolio. So for example, $2,000 or $3,000 in something like gold.
Okay.
You see what I mean? And then the remaining percent of that $10,000, I would put in something that has long-term growth potential, okay? That has huge asymmetric upside, a very favorable risk to reward profile. And I would get involved in something that is not overextended from a valuation standpoint. Okay. So, for example, the stock market, equities market, it's in a parabolic move as we speak, it's in a melt up phase. But if you're a long term investor, now is not the time to be getting involved in the stock market. You're late. Okay. You should have been in several years ago, 5 years ago.
18 months ago, you'd have been.
Yeah,
okay.
18 months ago, exactly. Now you could get in. It will run probably for another several months, maybe a year if you're lucky, but it's going to have its correction at some point, and it could be quite significant. So identifying something that is still significantly undervalued actually gives you the best risk to reward ratio and the most asymmetric upside. And you want something that has long-term growth potential. So if you were looking at digital assets, for example, that do have that, it comes down to asset selection, because not everything is going to rise over time. And certainly most of these digital assets are likely not going to be here in the next 5 or 10 years
Yeah,
because
exactly.
they're not going to be relevant.
Yeah.
So I would actually look at something like XRP, something like XLM that have huge amounts of liquidity on their networks, that are notable, that have real use cases and utility, because that increases the long-term potential of success
Yeah.
over many years in the decades. And they have growth potential. They have institutional interest and backing. So it means they're not likely going to disappear tomorrow because of some event. And they have long-standing history of surviving multiple bull and bear markets. So
Would
this is
you-
a very
Would
critical
you
factor.
put in any Ethereum or Bitcoin in that same portfolio, or would you stay strictly on XRP and XLM?
Well, that
I'm
goes
gonna
back
get
to the
yours,
risk
Versan.
tolerance.
I'm gonna get yours. Don't worry.
Yeah, that goes back to the risk tolerance, because you see Bitcoin has already made most of its moves over the past decade.
Okay.
So you can still have a good performing year and cycle with Bitcoin, but because Bitcoin has made phenomenal gains over the past decade, as a market or an asset matures,
Yeah.
the returns begin to compress. This
Yep.
is natural. Every
For sure.
investor knows this. Okay, so if your goal is to have outsized performance, it's not going to be in Bitcoin. That's why Bitcoin is being used right now by a lot of wealthy individuals just to preserve their wealth through these cycles. And they don't hold forever. They de-risk when it's overextended, they buy back when it's lower, and they keep reaccumulating and repeating the process.
Yeah.
But this is a wealth preservation mechanism. It's not essentially, I'm going to create wealth with this. So I would go for XRP or XLM instead. Consider that.
Versan, all right. So we got gold, XRP, XLM.
Well,
Vandell.
I have a few things I'd like to share. Well,
Okay,
first
go ahead.
My friend Ido and I, we did a podcast warning people about, for instance, the IPO of SpaceX, right?
Oh, that was what a mess.
Yeah, well, we were right about that. And, you know, we were trying to tell people before this happened that the IPOs are going to be liquidity events for the insiders, not investment opportunities for new
100%.
buyers at those prices. So we were telling everyone not to get caught up in the hype, step back, and of course, protect yourself with assets that have proven they have value, for instance. And in my portfolio, I'm very aggressive with a few digital assets. But to answer your question, you know, gold solves one problem, and a settlement bridge is going to solve another. For me, gold is how I preserve my wealth. It's a superior natural store of value.
And you like physical gold, right?
Of course. Yeah. And it's all I buy, and I use cash to buy it too. And a little gray area, so there's no digital trace if they ever try to come after me. I'm just kidding. But you know, XRP, it's also a very important tool. And if I may share a theory I have with you,
Okay,
and the
let's hear it.
audience, the reason I have many investment standpoints on why I own XRP, but I have a structural theory on why XRP in the next decade, maybe 20 years, could become the most liquid asset in the financial system.
Wow.
And we tie it back to how the dollar got to become the most liquid asset in the financial system. And it became the most liquid asset because it was the primary settlement instrument for all global trade and financial obligations, right? And that's where settlement concentrated, and liquidity was the result, right? And that's why the dollar is the most liquid instrument today. That privilege now is being challenged, and it's under pressure for the first time in a very long time. Now, we are moving into a digital economy, a multipolar world where no single national currency is going to perform the role of the dollar, a dual role where it carries the political risk, the operational cost. It's very expensive now to do trade with dollars because of the debasement trade as well. So the settlement demand is not going to disappear. It's migrating, and that's what we see happening. It's going to look for the least amount of friction and lowest political entanglement with the United States. And that's, again, where XRP sits, at that exact point where the migration is beginning. And with stablecoins now, as more regulated digital dollars become programmable in this crypto ecosystem, as more AI agents select the most efficient path without caring about the narrative and this human emotion sentiment, with the political risk gradually being reduced, and the cost of the old rails again keeps rising because of fragmentation. So where am I going with this? The more settlement that is going to happen through XRP, it's not about replacing the dollar as a reserve, but it's going to absorb a lot of that demand for settlement. And that's what's going to eventually result in a restructuring of the price later on down the road. So it's the fact that the asset XRP as an investment standpoint, from an investment standpoint, sits in the middle of where these new flows will eventually have to come through, right? So it's in my portfolio, I'm very aggressive with XRP. I've done incredibly well since we got in at 18 cents. Yes, the market feels boring right now. It seems like there's no sentiment anymore, and that's okay. That's when you should be paying attention, really. And I think that does tie into the Clarity Act, which you mentioned earlier, because in my view, the Clarity Act is truly theater. And if I may also go on another rant and explain this, is that all right? Well, the reason I say the Clarity Act is theater is because Vandell has explained this many times also. We have seen patterns in the past with major bills
Right.
and major headlines that get past these milestones where they just keep the process alive just enough to generate retail sentiment and excitement. And they use that as a liquidity exit for the large players. For anyone who's really paying attention to the evolution of money, it's undeniable that finances are going on chain. Assets are now being tokenized. Transactions are settling in seconds. And Ripple, XRP, Stellar, XLM, and a few other major players, they've been building the utility, the compliance, the infrastructure. So they're not really waiting for permission. In many ways, they're the ones writing the rules for the new financial system. So I would tell everyone to ignore the noise, the headlines, because it really is going to keep oscillating between the hype and the disappointment for the short-term price action. Yeah.
Well, I think to your point is what we have seen around this has been such a yo-yo of regulatory highs and lows. I mean, here's another one that happened this week where, the Senate was kind of pushed by Trump, and then now all of a sudden you've got all these Russian sanction elements that have just all of a sudden shown up and have now taken, kind of the limelight in terms of whether or not Clarity even gets voted on at the Senate level. So this is just to your point, theater at its highest level. And of course, this only opts in because we have continued to see, Versan, the amount of banks. I think the banks are in on this.
Of course.
I think they're part of the theater.
Yes, exactly.
The court cases and all the headlines are designed to delay things, of course, but it's buying valuable time for them if you think about it.
Yeah.
Because it gives time for more and more countries around the world to test de-dollarization.
Yep.
It gives more time for them to buy more gold, right? For big funds to keep stacking real assets and test these new settlement systems that we're talking about. It gives more time for the multipolar world to really take shape before the official rules catch up with what's already been decided. And to your point, the banks are involved. The people at the highest levels of government and the financial institutions, they know this is coming. They're quietly doing this, and they don't have to announce it on television.
Yeah.
The Clarity Act is simply the moment where the rule book is going to finally match and catch up to what's the work they've already done, what's been decided. So in my bigger picture and long-term view for this, patience is really our edge right now. And, taking a step back, looking at that bigger picture, it really helps you have this ease of mind where you don't have to constantly worry about the ups and downs in the market.
What do you guys make of what's happening right now in Japan? Because you've got net dollar shorts being held by Japanese retail accounts. This is like quadrupled in June. Quadrupled in terms of truly going at, and this is the retail side of net dollar shorts. What does this do? Because if Japan continues on this track, we've done a couple of videos on the expansion of Japan's digital ecosystem. Their prime minister is all in on literally, you name it, XRP to the Japanese stablecoin that's now being utilized across most of their retail ecosystems. Plus, they just dumped their tax system from 50 to 20 on crypto gains. That's a pretty big leap, and it's very fast moving. What do you guys think?
Well, I think Japan is going to eventually run into an issue. That's ultimately how I see this. That's the destination I think they're heading to. And I think they're going to have to respond with some sort of central bank intervention.
Yeah.
And ultimately that's how I see it. So it's simply because of the nature of the financial system and the debt-based mechanics of this system. Eventually they're going to run into some problem, and they're going to have to step in and inject liquidity into the system. That's the only direction I see it going.
Yeah. How much of an impact do you think that has on the U.S. securities market?
Yeah, I think that could spill over, but then we would see a response over here in the West as well.
Yeah.
So I think it would be contained largely through central bank intervention
Yeah.
and injecting liquidity into the markets. But
Yeah.
Are you referring to the reverse yen carry trade kind of spilling over?
The point is that you've got retail now shorting the dollar in Japan, and this is a significant amount. If that is happening on shorting the dollar, you've got the reverse carry trade maybe fully intact again, but this has been so close to executing forever, and they always come in and bail it out at the end.
That's what I'm saying. Yeah.
Versan, how does this play out?
Well, like I said earlier, one of the catalysts for not just XRP, but for the entire the unwind of the carry trade is that it's getting more and more expensive to use these legacy systems.
Yep.
Right. And that's the real problem here. How long can they buy time? That's the risk now, of course, to what a lot of people have been talking about is if the Bank of Japan accelerates its tightening, or so my brother said, central bank intervention, it's going to force rapid appreciation of the yen, right?
For sure.
But there is deleveraging across global markets. So that's an important factor. Sudden liquidity squeezes, volatility spikes.
Right.
Now, that's where some people speculate, and I'm one of them too, that it could be a catalyst for where this neutral high-speed bridge asset can help in this kind of environment. And that would explain why these relationships between the Bank of Japan, the Prime Minister of Japan in the past, saying that by 2025, I think everyone remembers this, that all banks in Japan will use XRP.
Yep.
It's very possible they already are using it.
Well, the partnership with Sonium and Sony in general, you look at what's going on with SBI, essentially the JP Morgan of Japan, all of this has been fast-tracked in the last 3 months. And to me, when you move regulation that fast with everybody on board, there's something up. Something is up in Japan. I don't know if they have a plan coming out of this or how they plan to do the unwind, but there is something up.
There's a time and place for all of it. But,
yeah, I was going to say, as for the dollar specifically, the DXY, I actually see it rising in the not too distant future later this year. That's what I anticipate. Yeah. So this is from a technical structure. Okay. So from a technical perspective, it seems to be breaking out of this triangle that it's been in. And it aligns perfectly with where we are in the late stages of the credit cycle.
Okay.
So the DXY, I anticipate, is going to strengthen a little bit more. And when that does happen, essentially what that means is there's a global contraction in credit in the world. That's basically what's happening when the dollar strengthens. So I see that happening before it eventually rolls over and comes down all the way to maybe 92, 90, in the low 90s. That's how I see it. And when it does come down, I actually anticipate that would align perfectly with liquidity being injected into the system and with rates coming down significantly. But I do think the dollar is going to stay consolidating and strengthen before that happens.
Well, it's strengthening right there. as you can see, the Dixie on the chart holding at 101.3. And that's been driving up for quite a while too. So maybe to your point, you think it could go higher than that? Let me go to the weekly.
Yes, I do. I think it's going to go higher than that.
I mean, yeah, you look right here. Back in, when is this? June of 25, we were setting at what? Jeez. Wow.
Well, you know what's
109.
interesting, Paul? If you actually look at the DXY chart, pretty much every time the dollar has reached its high, its top,
Yeah.
that was actually when Bitcoin topped. So,
Yeah.
interesting correlation there.
Yeah,
Yes,
for sure.
But I do anticipate that to happen again, and eventually the dollar, the DXY, to roll over, and I
All right,
think that's
so
going to align.
last point I want to hit at, for a lot of people right now, they have been waiting for this last capitulation phase. Do you guys think we are in it right now, or at least the beginning of it? You think that we have begun the last capitulation phase, or do you feel like this most recent acceleration from 59K on Bitcoin up to where it is right now, 64 or so, hit 65 this week? Where would you stand, Versan?
Honestly, I think we could go lower. And the only reason I say that is really because of the geopolitical factor.
Yeah, yeah.
And which is widely unreported in my view, how it, is systemic to today's markets.
Mm-hmm.
People don't talk enough about the supply chains breaking down. At the end of the day, there could be a liquidity crisis because I think more people are going to worry about putting food on their table than trading the markets. And,
Yeah.
My final point would be really, I don't know. I think we could go lower, and that's why I do have cash on the sidelines.
All right.
But for anybody out there chasing quick returns and reacting to daily headlines, that's a mistake. I think people need to
Long
think
term.
about long term, yes,
Yep.
because real wealth is built slowly over months, sometimes even years. For me, it was a few years, and it really changed my life. I didn't have instant gratification. So just that long term thinking is really what works today.
Yeah.
The transition is obviously being very volatile. But if you have a clear direction of where the signal is instead of the noise, then, I think you'll be okay. We live in very dangerous times right now.
Yeah, no doubt. Vandell, when you look at timing here, now we know, all right, we could be in a phase for capitulation into these markets, including coming off the S&P 500, which is where we could see rotation of capital coming in. Would you put that in 27, 28 on a presidential year, or timing wise now is going to get critical?
Yeah, I think the new bull market will actually begin in 2027, and I think it will be even stronger for the outperformance will be even stronger for quality digital assets and the broader crypto market in 2027 and even into 2028. That's how I see it. And simply because, believe it or not, Paul, the cycles have not deviated from their historical patterns. They're following the same patterns. And if you actually look, I use a lot of moving averages to determine the overall direction and the trend of the market and get a sense of momentum. And what's interesting, even if you look at XRP, all these other quality digital assets, XLM, most of the crypto market are trading below their medium-term and long-term trends. So they're moving averages, simple moving averages. They're trading below 100-day moving averages. They're trading below the 200-week moving average, below the 50-week moving average. This means they are still in a stage 4, which is a declining phase of their cycle. They're trading below their 30-week moving average. So the downtrend has not finalized. And if you take the context of the the term election cycle and where we are in the credit cycle, what's interesting is every midterm election year has historically been one of the weakest years for the equities market, including the crypto market. Okay. Now, what's interesting is every midterm election year, going right into the midterm elections, you could see Bitcoin in the crypto market has dumped further. So I think it's very premature to conclude that, okay, this is the bottom, because What we have seen so far has been, sure, a decline in price, broadly speaking, in the crypto market.
Right.
XRP down more than 70%, Bitcoin down more than 50%, but we have not seen a full price capitulation final flush out. We have not seen that yet. So between now and going into the November midterm election and the end of the year, what that means is we still have a window where a lot can happen in between. And historically, it has happened where we have seen further price drops in the midterm election, November.
Right. Yeah.
And even if you look in the historical chart with the equities market, historically, August, September, we typically see a correction in the equities market.
Yeah.
In midterm election years. Now, if that happens, whether it's a 10%, a 20%, if that happens later this year, what do you expect will happen with the crypto market?
Exactly.
Even if it is already down, it will come down even lower. And my moving averages, I found every Bitcoin cycle, crypto cycle, the 300-day moving average was touched, okay, for Bitcoin, which means we could fall even further to 54,000,
Right.
between 48, 54,000 in that range. It's possible. And we could also go lower if something happens that we aren't expecting. But basically what I'm saying, Paul, is there are two types of capitulations. There's a price capitulation, which we have not seen yet, and then there's a time-based capitulation. And by the time we get to the end of the year, Q1, January 2027, if we have not had a price capitulation, then we can reasonably conclude that, okay, this was the bottom. The timing could be, yes, exactly the case. But we still have time. And every midterm election, we have dumped further. So I expect that to happen. And I expect it to bring the market down slightly lower than where they currently are right now.
Yeah, 90 days essentially to midterms, guys. So here we are, end of July, going into early August, and early November, we've got midterms hitting. That is exactly the timing here. So this next 90 days is going to be super volatile. So get ready. We're going to have the guys back on to talk more about this in a few months to kind of cover up and see if we were right or not. So you guys know what to do.
We could also expect a relief rally. I just want to say
exactly,
that, which is typical during late stages of the cycle. So
accumulation phase of the liquidity cycle too. Yeah, it's the precise setup for some sort of relief rally or explosive leg higher.
Well, and if you're playing short-term markets, those are always good to participate in. But if you're looking at long-term, it's just another blip on the chart.
Exactly.
You know, so.
Well, you need a two-tier strategy as far as crypto. If I may share this also, this could be very beneficial to everyone. So I have a three-tier strategy where it consists of assets that are outside the system, gold, silver, cash, etc. I do have a tier 2 where it's specifically my high conviction strategy for the real wave ahead, right? For a bull market that will ignite when rates do collapse. And these are my core long-term holdings, which I don't touch. I've been holding them for many years now. XRP, XLM, HBAR, Aljarrah, SHX, Velo, Quant, and a few others. And I have tactical opportunities too, where I concentrate a large amount in maybe two assets. In this case, it's SHX and Velo. And I wait for the return of liquidity to flood the system. Market starts to have this asymmetric upside, and I cash out 90%. Pay taxes and rotate it back.
Done. Yeah, rotate around.
Yeah, and it works. It works. So I think everybody needs to be not just sitting idly by and letting inflation outpace how fast you can earn the money. You need to actively engage in the market if you're trading. So long term and short term.
Big time, guys. Lots happening here. We will be covering this and so much more on the podcast. Of course, Versan and Vandell, thanks so much for coming in today. We appreciate it.
Thank you. Thank you, Paul.